The lending window is open. It has been open since before the war began. No one has closed it. The reserve system was designed for peacetime credit. The war arrived before the design was revised. Banks submitted paper. The window accepted paper. The volume grew. The procedure did not change. Capital moved from reserve vaults into war bond markets. The vaults were not designed for this scale. Member banks borrowed freely. The rate held. No mechanism existed to slow what the policy permitted. The discount rate was a peacetime instrument. It remained unchanged as wartime demand accumulated around it. Treasury needed financing. The Federal Reserve provided it. The boundary between the two grew indistinct. War bonds were sold to citizens. Banks held them as collateral. The system accepted its own instruments as proof of solvency. Reserve balances thinned. The reporting cycle was monthly. The imbalance existed before anyone measured it. The eligible paper rules had not been written for sovereign debt. They were applied to it anyway. No rule prohibited this. Credit expanded into industries the reserve system had not anticipated. The window remained open to all of them. District banks operated independently. Coordination was advisory. The imbalances did not distribute evenly. Prices rose. The price signal was visible. The lending rate did not respond to the signal it was designed to read. The Federal Reserve Act gave the board authority. The board chose accommodation. The choice was recorded and filed. The money supply expanded past the gold cover ratio. The number crossed. The constraint had been nominal for months. Gold reserves sat in vaults below the mandated floor. No alarm existed to register this condition automatically. Correspondent bank networks carried credit between cities. Each transfer reduced the visibility of where the exposure actually sat. The war ended. The lending window remained open. No mechanism required it to close when conditions changed. Postwar demand absorbed the wartime credit. Prices accelerated. The system had not yet been asked to decelerate. Internal memos described the inflation. The memos were read. The discount rate remained where it had been set. The political cost of tightening was visible. The financial cost of waiting was not yet visible. The wait continued. Credit continued to flow into commodity speculation. The reserve window had not distinguished this from productive lending. The Federal Advisory Council met quarterly. Its recommendations were non-binding. The structure continued without external correction. Those who document systems like this do so because the record itself becomes the only restraint. History accumulates where policy did not act. Inflation reached double digits. The Reserve Board met. The rate did not move at that meeting either. Agricultural credit had expanded through member banks in rural districts. The expansion was indistinguishable from wartime necessity in the ledgers. Farmland prices had risen on borrowed expectations. The collateral supporting rural credit was the price level itself. The Federal Reserve's new leadership convened in 1920. The rate decision they inherited had been deferred for 2 years. The rate was raised sharply. Credit contracted. The correction that had been deferred arrived compressed into months. Banks called loans. Borrowers defaulted. The defaults had been implicit in the credit since it was issued. Rural bank failures accelerated through 1921. Each failure had been solvent the year before at the prior price level. Farm commodity prices collapsed. The land values that had collateralized the credit followed them downward. The Federal Reserve issued a report on the contraction. The report was thorough. It did not describe the lending window as the cause. Unemployment reached 11% in 1921. The contraction lasted 18 months. The window had been open for years before either number appeared. Congressional hearings examined the Federal Reserve's conduct. The testimony was recorded. The structure of the window was not altered. By 1922, the economy had begun to recover. The recovery obscured the mechanism that had produced the crisis before it. The discount window was redesigned in minor procedural ways. Its fundamental operation remained continuous. The next cycle inherited the same instrument. 4,000 rural banks had failed between 1921 and 1929. The failures were absorbed as individual events. The system continued without structural revision. The credit expansion of the mid-1920s moved through the same window. The instrument did not remember what it had previously enabled. The structural vulnerability documented in 1921 had not been addressed by 1929. It had been administered around. That is a different thing. In October 1929, the reserve system faced a contraction larger than the one its window had helped accumulate. The procedure remained unchanged. The window was still open. It had been open without interruption. That continuity was the condition, not a coincidence. Systems do not fail at the moment of failure. They fail at the moment they were allowed to continue past the point of correction. The Federal Reserve Act was eventually amended. The amendments addressed the symptoms the window had produced. The window itself remained. The lending window is still open. It has operated continuously since 1914. What it permits has always preceded what it produces.